people confuse anonymity or pseudo-anonymity with privacy. It's not. We don't expect the bank every time we withdraw money to announce it to the world. And yet today, if you go and make a transaction on most blockchains and you make a withdrawal, everything is visible.
What is the risk for you in that standpoint when it comes to the government and privacy?
Regulation, if it's done intelligently, will actually be the biggest driver of mainstream crypto adoption, not its biggest threat.
Meet Fahmi Syed, president of the Midnight Foundation, an independent organization in the Cardano ecosystem dedicated to advancing a privacy-first blockchain. With a career that spans from hedge fund giants like Marshall Wace to pioneering with Polkadot and Parity Technologies, Fahmi explains why he thinks privacy is the next biggest thing for crypto. In this episode, you will learn how Midnight, a blockchain that leverages zero-knowledge proofs, can deliver a powerful combination of privacy, sustainability, and decentralization for both enterprises and individuals. What would be one piece of advice you would give to someone that's going to look at potentially building in Web3?
Don't do it. This is not just Cardano, this is more than Cardano. We're going to distribute to 8 different ecosystems: Cardano, Bitcoin, Ethereum, Solana.
What's something you believed in 5 years ago in crypto that you've completely changed your mind about?
Oh, that's a good question.
I know.
So
before we continue, I would like to ask you for a favor. New Era Finance is designed and started to educate you about the future of finance. And I think that blockchain and Web3 is going to rebuild everything that we know about finance. And that's through those guests and the in-depth conversations that we have. However, more than 80% of you are watching this without being subscribed. And if we get more subscribers and more views, and we can start building this community, we can get better guests, we can improve the content, and we can start building. And in that way, we can start educating you even more. So I would like to ask you for a simple favor to check whether you are subscribed. And if you're not, please do, so we can start and continue to build this channel towards a bigger channel to help you all. Thank you very much and enjoy the episode. Welcome to the show, Fahmi. You've had a impressive track record going from hedge funds into Web3, several different projects within Web3. But first, I ask this to every guest. What's been the most exciting news item that triggered you over the past few weeks?
Hi, Michael. Pleasure to be here. Thank you for inviting me to your show. Well, the most exciting news in the last sort of week or two has been the announcement of GlacierDrop by the Midnight Network. The GlacierDrop is an innovative, radical approach, putting community first, where we are distributing 100% of the Midnight Network token supply, the Night token, to the community across 8 different ecosystems. And thus far, in just over 1 week's time, we've had over almost 5% of the tokens being claimed. We're about 4.5% rising towards that 5% mark. That's over 1 billion tokens have been claimed, almost 60,000 claimants across the 8 different ecosystems. So that's a very encouraging place to be so early in that phase.
Well, congratulations on that. And I think that the market circumstances have changed and definitely helped by all the things you're achieving with Midnight. We're going to talk about Midnight in a little bit, but first, you've got a pretty long background in hedge funds.
Yes.
And now we see that the crypto markets are, I think, changing due to the institutional investors that are coming in through the ETF. From your standpoint or your experience, how are the crypto markets changing through the ETFs? Are we still going to have 4-year cycles, or is it just completely out of the books?
Yeah, that's a very good question. So I think what we saw with the advent of Bitcoin and then Ethereum and then the chains that followed in the 3rd generation was a drive for innovation. How could blockchain technology change the fabric of how businesses worked, how society worked, how that interaction sort of took that central player out of the system? So removing disintermediation and all of those factors. But what we've seen over the last 3-4 years is more and more investors coming into this space. So it's become a more a marketplace about the token and less about the project, less about the fundamentals of the project. So what we're seeing with ETF sort of platforms and purchases is mainstream adoption of Bitcoin and other crypto tokens. So what that will result in is some dilution of volatility. As more and more institutional players come and buy Bitcoin, you'll see less volatility in that marketplace. And it's almost taking blockchain away from its true nature, its true ethos. In fact, taking away from the ordinary person, which blockchain was meant to change how they access financial markets or access systems. So it's become, and regulation is changing that as well, it's become a marketplace for the large financial institutions. And that, again, is a shame considering what Bitcoin and Ethereum were meant to be doing for platforms, for businesses, for developers.
I think I agree, but the funny part is that retail actually had the opportunity to invest into this asset at an early stage. So it basically, retail has made it big and then institutions are taking over. But it feels like we need regulations and we need the ETF and we need the money flow into those assets to actually get into adoption. Because we kind of hit a ceiling in terms of how far we could get, and we need bigger enterprises to build products that everybody can use.
Yeah, that's very fair. Look, I think I'm as a gentleman with history and background in the financial industry, I fully agree that you need large institutions to come and adopt. But what we're looking for is adoption of the technology, less about the crypto tokens themselves. If the technology takes hold and we get large real world use cases of the technology, then we have a proof that blockchain technology, decentralization actually has a purpose and has problems it can solve, as opposed to just bringing liquidity in. And look, volumes from large institutions is great. As I said earlier, it dampens volatility, and that helps retail investors just as much as it helps the large institutions. And large volumes like that help the smaller person get in and get out easier. But again, I go back to what is the reason for the blockchain movement? What was the rationale behind it? And how do we go back to actually looking at the technology as opposed to just trading the tokens?
Yeah, and I'm sure that when we talk about blockchain, we're going to talk about on-chain activity, privacy a lot today.
Yes.
But first, I've been diving into your background, and you came from the hedge fund world. I'm personally having a liquid fund, so I'm trading high frequency myself. And you jumped over to the Web3 ecosystem previously at Polkadot, and now basically the Cardano ecosystem. What made you decide to jump over from hedge funds into the Web3 space?
Yes. So I was very fortunate to spend 17 years at a hedge fund called Marshall Wace. Very entrepreneurial in nature, very driven, but became very institutional just because of the growth and the scale that they grew accustomed to. And in those 17 years, I was very fortunate to work with a lot of software developers, a lot of quants. It was all about how you make business and trading and all activity simpler, more efficient, and where technology could always help. So I was always in that space around, smart engineers, smart developers. I then was very fortunate to help the former Citadel CIO in Europe launch his sort of standalone hedge fund. And at that time, I'd gone from a very large hedge fund managing many tens of billions of assets to a smaller one. And I learned exponentially through launching a brand new hedge fund, launching a business. But at that time, I was looking for something new, something to go and challenge myself. And as it turns out, it's serendipity, quite frankly. It was a chance call from a recruiter who said, look, we're interested in somebody with your background who'd be willing to come into the blockchain industry. And initially, when they told me about it, I was a bit skeptical. I didn't really understand it. I read about blockchain, but it's not an industry that I was focused on. But as I learned more about Gavin Wood, what he'd achieved in his career, what he'd achieved in terms of building solidity in the Ethereum virtual machine and his role at Ethereum, and then what he'd gone on to do at Polkadot, it became really interesting. And what I realized was it was potentially an evolution of technology, an evolution of technology that could change how business worked, how data was held, how you remove disintermediation. So I jumped headfirst into that rabbit hole.
Well, that's a big jump. But then you've decided to basically move ahead from Polkadot and start working directly with Charles at the Cardano ecosystem.
Yes.
Why did you make that change? As in, both are original Ethereum founders.
Correct, yes.
And both have a different vision.
Yes, very much. So, look, I spent over a year and a half at Parity working with Gavin, working with his engineers, working across that company, also working closely with the Web3 Foundation. I thoroughly enjoyed my time there. I learned so much. I spent many times traveling to their Berlin office and to other places to spend time with their engineers. To really, part of the reason I joined blockchain was to grow, to develop, both intellectually and professionally. And I had a great opportunity at Parity with Gavin and his very excellent engineers to just learn more about blockchain. What was the technology? How does staking work? How do you evolve that marketplace to bring in more institutional demand, but also keep building around that same philosophy of delivering a technology back to the people? And after about a year and a half, Parity was going through some changes. And again, at that time, what happened was I was approached by Charles and Hoskinson of Cardano and Aram Barak, who was then the CEO of the project that was being incubated with an input-output. And they told me about what Midnight and what they were trying to do with Midnight and how they believed that both identity and privacy or data confidentiality was the key to real-world adoption of blockchain technology. And the more I spoke to them, the more the project became interesting. And it takes me back to my roots in my hedge fund world, where I always worked in a startup environment. I was always building businesses, helping build technology to make businesses more efficient. And here is an opportunity for me to work with Charles and Iran in helping launch Midnight.
Well, there are a lot of comments on the Cardano ecosystem over the years. It's basically one of the most discussed coins or projects over the past decade, outside of, I think, Ether, Bitcoin, and probably XRP. What is the biggest misunderstanding when it comes to the Cardano ecosystem that people are not seeing? Or, like, there's a lot of people that are saying Cardano is dead, but I'm for sure understand that you have a completely different thesis. But why is that misunderstanding taking place on social media when it comes to Cardano?
Yeah, that's a great question. So again, when Charles approached me, I heard the same things. I heard, don't go there. Charles is a very different character to Gavin. The ecosystem itself is not developing. But again, let's look at the numbers. Cardano has consistently been a top 10 ecosystem. There have been many who've come and gone in this period since the ICO boom. And yet Cardano remains consistently in the top 10 or in and around that top 10. And I think the misconception there sometimes is around Charles and his vision, and people fail to understand what he's trying to achieve. He's very much a libertarian who wants to put power back into the hands of people. And he has a very strong conviction around that. But what has happened in the Cardano ecosystem is, and again, this is true of many ecosystems, is often the engineering and the research that goes into the blockchain sometimes can be at the can overlook the commercial aspects. How do you encourage more builders to come? What makes life easier for them to develop? So UX, languages, platforms. How do you create liquidity in a system to create a vibrant ecosystem? And that exists within Cardano today. But again, the conception is it is because it's UTXO, like Bitcoin, and Charles took that route and didn't follow the EVM route and the ledger-based system that others followed. that it is a standalone platform. It is a standalone ecosystem. And I would encourage people to actually look at what's going on, the depth of what's happening there, and actually its interaction and liquidity across the board.
Has it also something to do with the fact that this is something that I just keep on coming back with when I interview, when I talk about projects and protocols? There are a lot. Like, for instance, Polkadot has a vibrant ecosystem themselves.
Yes.
They have been building some great projects. And then Cardano is actually growing. Then we have Chainlink doing great. Optimism has the OP stack. But all those ecosystems continue to grow, but the token itself is doing basically nothing. Is it just because building a great token and great tech are two different components of having a blockchain, or
yeah,
how do you see that?
Yeah, look, again, if you look at the history of the very short history of blockchain, often the token price and the ecosystem or the technology don't often go hand in hand. The token price, particularly in blockchain industry, sometimes is not based on fundamentals. If you look at the equity world, equity prices are based on fundamentals of the business and its ecosystem, but also future expectations of that company. So the price of a stock and equity is often what people are willing to pay, what they see the future value of a company to be. Tesla is a great example. Tesla in the past was not profitable, and yet people saw that as being an innovative company. And at one point, Tesla's market cap was bigger than the market cap of almost every other major car manufacturer with, decades of history. And blockchain and crypto tokens have a similar kind of impact. Often it's the perception of the ecosystem and the project which can have a material impact on the token price and not the ecosystem or the technology itself. You speak about Polkadot, and I had, like I said, a wonderful experience with Polkadot. And Gavin is a thought leader in the space. I mean, few would argue that he's one of the best engineers of his generation. And yet, if you look at Polkadot with its vibrant ecosystem and technology, if you look at the market cap, it's been declining, or its position in the top 10, top 20 has been declining. And that's not to say that technology is any worse than it was 5 years ago. It's just a market perception around what is happening. Take Solana. Solana, for many periods, many years, people questioned whether the blockchain was stable and robust, whether the uptime was there. And yet it has a vibrant community because as a Solana ecosystem developed, they put a lot of thought into how they develop the community. And it's that community demand and vision of what the Solana ecosystem could become, which arguably drives the price. And that gives you the time to then build the technology alongside it. So I think sometimes the crypto price and the technology aren't reflective of each other. It's very much like the equity world around sentiment, around the future value proposition of a particular platform.
I agree. And ultimately, if you want to grow as a protocol or an ecosystem, you need the price to go up because it just expands the liquidity that you can pour into the ecosystem to grow. The thing is, though, with a lot of layer ones is that they are so insanely highly valuated that the treasury is just big enough to keep on going while the token price keeps on falling. But there are so many layer ones out there right now, and you have decided to build on top or work with Cardano.
Yes.
What made you decide to do that, and how is the Cardano ecosystem basically assisting you in your vision for Midnight?
Sure. So the Midnight project began as a research paper from one of the various institutes that the Input-Output group, backed by Charles Hoskin, works with. So the Kachina paper was the genesis of the Midnight project. And then Charles, as a visionary in the space, as a student of this space, and as a multiple times founder, believed that there was enough substance there around both the research paper, but also the doctrine of identity and privacy being the core tenet that was missing from the previous generations of blockchain. If you think about blockchains generally, they're all transparent. What Bitcoin gave was people a new platform, new technology, where you suddenly had a freedom of association, freedom of commerce, a freedom of expression, all of these without censorship, without intermediation, all produced mathematically through cryptography. And suddenly that, encouraged and ushered in a new era of technology, which Ethereum brought in terms of programmability, and then Cardano's Polkadot and Solana brought through both scalability and interoperability. But the issue has always been, we haven't really seen real world use cases of that beyond trading the crypto token itself. Like, no large company is using blockchain as part of their technology stack. So if you think about the evolution of cloud computing, if you go back a decade or more, CTOs were saying we would never put our servers into the cloud. We would never trust somebody else to manage our data servers. And yet today, almost every company is putting all of their data on clouds managed by third parties. But yet the same doesn't happen in blockchain. So in the Cardano ecosystem, what Charles has been doing is encouraging the build out around the Midnight project, have very much been incubated within input output. And then as part of the transition into the launch of the Midnight ecosystem, we've set up the foundation. The Midnight Foundation is responsible for the growth, governance, and stewardship of the Midnight network. And then from input output, we've seen the spin out of Shielded Technologies, which is the Labco, the core engineering firm behind the build out of the Midnight network. And it's on the foundation to encourage further growth, to bring in new builders, to grow the community. And what we are doing as part of our launch is using the Cardano platform to launch our utility token, Night. And Night gives you ownership and governance of Midnight Network, which is a separate L1, a separate blockchain. But by using Cardano to launch, we inherit Cardano's robustness, its security, and its liquidity and access to markets. And that, certainly as a new project, helps us immensely in many of the conversations we've been having. The other benefit of being working with Charles and input output is we're not backed by VCs. So we don't necessarily have a very short time frame in which we need to deliver. This has been developed over 5-6 years. So when you have a founder with strong belief, strong philosophy, as well as strong funding backing him, this project has been evolved into something that we believe is truly unique and takes blockchain technology forward in terms of next generation abilities.
If there's always a big sort of discussion when it comes to VC investing. I mean, in Web2 space, it's very common to have VC investors, otherwise you can't really progress.
Yes.
But in your case, I think the foundation, the Cardano Foundation, has been providing liquidity to build the protocol?
It's not Cardano Foundation, it's been input output. So Charles Hoskinson, as founder of Cardano, his engineering and research company is input output. So it's input output and Charles who backed this project entirely from day one. It has been incubated initially through researchers, then their innovations lab, and only a couple of years ago, it became a sort of project that was coming to market. And the project's evolved while it's been, again, the advantage we have being backed by Charles is he has deep pockets and he has time. He's a perfectionist. Often when you're backed by VCs, the demand there is to build quickly and to deliver quickly. And therefore, sometimes technology comes, which is not quite perfect or not quite where you want it to be. We've had the time to evolve Midnight. It originally began as an EVM project. And then we realized, and this is before I even joined the project, that privacy in its truest form, where everything is shielded by data and metadata, could not be truly developed and delivered on an EVM platform. And therefore they went back to basics and rebuilt. So now the platform itself is based on Substrate. So actually using the same technology that Polkadot uses. Because we recognized what Gavin and the Polkadot team did with Substrate was, very forward thinking. So we've used Substrate as the technology behind the ledger, and we've developed a unique smart contract called Compact. And together those systems give the ability to not only shield data and metadata, but also selected disclosed information. And we see that as key components to encourage true adoption of blockchains, to allow large enterprises and also Web3 developers to usher in and build the next generation of blockchain applications.
You mentioned that not having any VC investor makes you more relaxed, more flexible. Why are so many projects still taking VC investments, and what kind of impact does that have on the entire adoption of crypto, in your opinion?
Yeah, look, a lot of businesses, a lot of companies, as you say, in Web 2 and Web 3, they will start with an idea. Everything starts with an idea, whether you're launching a hedge fund, whether you're launching a Web 2 tech company, or whether you're launching a Web 3 blockchain. And often those ideas will evolve into somebody building something. But it takes a lot of resource in terms of people, in terms of engineers. It takes a lot of time, but it also takes a lot of money to develop a blockchain from scratch. And therefore, many founders don't have the deep pockets that Charles has. We're very fortunate that this project has been incubated by Charles with an input-output. And he's put some of his learning and education, but also some of the proceeds of his previous ventures and success into this project. Others don't have that opportunity, and therefore it is natural for them to go and look to get VC backing. But when you get VC backing, those VC investors have demands, both in terms of delivery and expectations, but also exit strategies. So while they bring a lot of investment, a lot of network, a lot of opportunities, at the same time, for the money they've invested, they want an exit. So more often than not, the timescales for those projects are truncated. They're shortened because of that demand for the VC investors to exit. And so the project and the philosophy has to find the balance between what their true vision is versus now having to answer to their new masters, the new VC investors. And that's a difficult balance. It's true in traditional worlds. In hedge fund worlds, you have the same. You have the philosophy around the investment thesis, but delivering back to what your investors demand in terms of making sure you have consistent returns and metrics that they believe that you are enabling them to access. So it is a different approach we've taken, which has allowed us to have more time, allowed us to hone the technology, and to really think about the thesis around what that technology does and what it enables. It also allows us to go and speak to partners, builders, community, to see and show them what Midnight can do for them, how it evolves their existing business, how it augments their existing technology. And Midnight's not just about building on Midnight. What we'd like to do with Midnight is also encourage other ecosystems to come and use Midnight. In every business in Web 2, people use different technology stacks. They use different technologies within their stack, different cloud providers, different hardware providers. The same should exist in Web 3. We should have a world where Solana builders are building Solana but using Midnight's privacy technology. And the same with Ethereum, the same with Cardano. We want to build a world going forward which is much more cooperative and collaborative rather than adversarial, which existing tokenomics leads to.
Yeah, I think that's what a lot of people still do not realize, but there won't be one chain, just there will be multiple chains for whatever purpose you need to use a chain, and they need to be interconnected or interoperable. Just like in the Web 2 space, there are multiple communication platforms like WhatsApp or Signal, or in different parts of the world, they use a different platform. One of the central topics for Midnight, and also actually what popped up in the recent months, is privacy.
Yes.
And blockchain took out the middleman, but gave back privacy.
That's right. Yes.
In terms of, if you go to a bank and someone at the bank needs to decide for you whether you can get a loan, is also giving up privacy. But now with blockchain, everything is open and transparent.
That's right.
And that's the exact opposite of what most people actually want, I suppose. Why is it that we see the entire topic surrounding privacy changing over the past few years. Like initially, everyone wanted to be open end to like have a blockchain that is providing all the transactions, and we had a topic surrounding privacy that was very negative back in 2017, 2018.
Yeah.
And now it starts to change. Why is that?
Yeah. So I think when Bitcoin was launched, as you say, it ushered in a new era of freedom, of flexibility, of removing that intermediation. A lot of that came about because of what happened in the financial crisis and some of the data leaks that were happening in the late 2000s. But as you say, people gave up. You had to agree to transparency. You gave up your privacy or your confidentiality. And I think the advent of zero knowledge, so ZK technology or ZK proofs, coupled with the cryptography technology around Bitcoin and newer chains, allows privacy to now become a component within blockchain infrastructure. And what we're moving to is from a space of privacy where it was fully shielded transactions to privacy with compliance. And that's key. That compliance element, the ability to disclose information, what you have to who you want rather than to everybody, is key to that evolution. And without that, then you end up in the world of either full transparency or full privacy. And we have to go back to, what does privacy mean? Well, privacy is data confidentiality, in another word. And we all expect data confidentiality in every transaction, every interaction with our internet. We don't expect the bank, every time we withdraw money, to announce it to the world. And yet today, if you go and make a transaction on most blockchains and you make a withdrawal or a transfer for collateral purposes or just buy and sell trades, everything is visible. And people confuse anonymity or pseudo-anonymity with privacy. It's not. People eventually, if you're large enough and you're interesting enough, analytics will allow people to identify your wallets, identify your behavior. And the issue with blockchains is all of that data is immutable. It's transparent forever. So if they don't discover it today, they'll discover it at some point in the future. So with Midnight, what we're looking at is using zero knowledge technology, where we are shielding in a unique way both the data and, more importantly, the metadata. And we do it in a way where we believe that that interaction, starting fully shielded, can be done in a compliant manner. When developers, builders use it, or enterprises use it, individuals use it, it's done in a compliant manner. And then the smart contract language, or compact, enables selective disclosure. We often refer it to as rational privacy, the ability to share information that you are comfortable sharing. So Michael, you and I, before this podcast launched, we shared some personal details, where we live. What are you doing this weekend? If you don't mind me sharing, you're coming to the UK for a wedding. That is information that you're willing to share with me because you don't think it's important enough or sensitive enough that I can go and use it against you. I've just shared it for the world to know, and hopefully you'll have a great time at the wedding and your friends will have a wonderful marriage going forward. But that's information that we're now choosing to share. But you didn't share with me your exact home address. You didn't share with me your bank details or your last transaction. And that's what we come back to around rational privacy, the ability to decide what you share and who you share it with and when you share it.
I think that's a very good topic, because every time when we have a guest, we do research, we get all the details from the guest. And I'm quite sure that not everything that's on internet, well, 100% sure, at least for me personally, I sometimes see data points on the internet that I'm like, well, I don't really like that to be on the internet. So that's also part of what you call rational privacy.
Yes.
The confirmation of yourself to approve that someone else takes some certain parts of your data. How is that different from SSID?
Well, the difference here is that in the technology that we're building, plus the partners that we're working with, the identity essentially sits with the individual. So in typical technologies today, even within Web3, we've seen various hacks where sensitive information has leaked. We call it PII. And that personal identity or information is stored by centralized players. Google, Meta, Coinbase. And the difficulties there, as secure as they can be and as much money as they have to put around cybersecurity, every now and then they have data leaks. We saw that with Coinbase. And every time that happens, you're asked to change your passwords, update information. But the difficulty with that is your personal data is out there. Your home address, your date of birth, potentially. So at Midnight, and with the identity partners and other sort of partners we're working with, is that information can stay in the hands of the individual or the enterprise. So there's no centralized actor storing information. So let's use that example of identity. Very, very often when you're asked to purchase something, you have to provide proof of identity. You go to a shop and you want to buy alcohol. You have to prove you're over 18 or 21. So in doing so, you hand over your driving license. But in that driving license, you provide information more than your age. You're giving away your date of birth. You're giving away your home address. And it doesn't have to be that way. And what zero knowledge technology allows is for that information to be held by an individual, but for them to present cryptographic, mathematical proof that they are above a certain age or they are within a certain jurisdiction. So think about financial markets, proving that you are based in the UK or in the Netherlands or in the US. That will give you access to different banking systems, different currencies. And that's where we believe the evolution of this technology goes, is that ability to retain and hold personal information and not put the data on chain, but proof of that data. And that becomes powerful for large enterprises. And as you only put the proof on the system, and that system is only, again, there to, or you open that up for selected disclosure, the important element around that is that nobody sees your activity beyond just a proof. And unless you have the keys on either side, you cannot discover what the actual underlying transaction was.
Yeah, so basically practical example is you have a certain wallet and then the government wants to check whether you actually have the assets that you say you have, and then you allow them to check it and to provide the data that they need to require to make that check. And inverse, if you go to, a grocery shop, you approve or allow the other person to check your date of birth and nothing else.
Yeah, absolutely. I mean, let's take today, most of the blockchains utilize, DeFi is, very topical and very embedded sector within blockchain. But every time you trade, before you even trade, you might have to move collateral, margin. You post it to an exchange from your custodian or your self-custody wallet. All of that is visible. Just the sheer action of moving collateral is a signal to the market of, are you long or are you short? So if the market's going up and you're consistently moving margin one way or the other, people can figure out what your position is and see what your trading behavior is. Now, that shouldn't have to be the case. Today, if you go and buy coffee with your credit card or with cash, nobody knows except for the barista on the other side and your bank. Yet you try and do a small transaction on any blockchain, everybody sees it. And it's trying to move away from that. We've just adopted that and got accustomed to it being the norm. And what we're trying to encourage people to see and visualize is actually there is a future in blockchain where the norm doesn't have to be that way, where there is privacy, where there is confidentiality. And when you have confidentiality, what you do is build trust. And that trust allows not only users to come in, but also enterprises and corporates to come in and other builders. Without that trust, we won't see mainstream adoption. We'll only see people trading the ETFs. So their information is not on chain, because essentially it's then governed by a BlackRock or a Fidelity. So nothing's really evolving in terms of adoption if we're not getting people actually building and using the technology stack on the blockchain itself.
It's funny. I was watching or listening to a podcast with the CEO of Wintermute, and there are a lot of accounts on social media posting about the flow of Wintermute on chain, and then making assumptions of what the position actually is, but it's completely the opposite. But it's super annoying for anyone that has usually a large position into a certain asset that once it starts to move, people start to behave and react on it. One question I have when it comes to rational privacy and having your own information and approvals and all those things is that basically if we would like to use Midnight and all our data is stored there, how are you going to make sure that Midnight can't abstract any data, or how is it stored that it sells in self-custody?
So actually in Midnight, we never store the data. The data is never stored on Midnight itself, just proof of activity. So Midnight itself cannot abstract data, there is no central player in Midnight that can abstract the data. What we're giving builders are the tools, or users the tools to execute private transactions, shielded transactions. So it's either the builder and the application itself, or the user who's delegated access for privacy. So the network itself never sees the data. You're taking the existing data, converting it to a proof which is presented on chain. And only the individuals with the keys to that transaction can unlock the proof and see what the transaction itself is. So we are very different to a centralized actor. We are decentralized. We are permissionless. There are private chains out there which are permissioned, like JP Morgan's Connexus network or Canton. And they all do a wonderful job, but there is a gatekeeper to that. There is a central actor to that. And equally, not only that, but they are siloed. What we're doing with Midnight is creating a meta layer, a layer that can connect to many chains or be built on natively, where it's permissionless. So it's decentralized. There is no censorship. There is no gating. It is there for builders with the open source code to come and build, to come and evolve. And the way we've designed the tokenomics, again, it allows either the builder to retain or the application to retain the proof and the proof creation, or they can be delegated to the user for them to have full privacy around their transactions.
What's the role of the regulator or the governments right now? Because, and for the people that are listening, how did that change over the years? Of course, we have Trump in the Oval Office right now. We had a very negative stance against privacy coins. What is the risk for you in that standpoint when it comes to the government and privacy?
Education. So understanding the technology, first and foremost. But regulation, if it's done intelligently, will actually be the biggest driver of mainstream crypto adoption, not its biggest threat. So if we think about what is happening in the US since the Trump administration come in, the US has gone from a jurisdiction where every builder, almost every chain was being sanctioned in some way by the SEC, or there's litigation in some form or another. So it drove innovation away outside of the US. What we're seeing with the Trump administration is regulation, which is moving in favor of the crypto industry, of builders. We've seen that with the Genius Act. We've seen that with the Clarity Act. And all of these things have seen almost large businesses in the space, Circle and others, moving to IPO stage. If you think about that, if I had spoken to you 2 years ago, 3 years ago, before the administration come in, you probably would have thought that was a crazy idea. So what regulators need to understand, like they did with the internet and Web 2, is how is this technology evolving? What does it enable? What does it provide? And privacy itself is a fundamental right. You use that in your physical world every day, just like our conversation earlier. You use that in your digital world. And in the digital world, it evolved. Regulation evolved. You've got GDPR or other acts around how data is managed by central actors. So in the same way, regulators, industry, and the industry as a whole will understand what zero-knowledge proofs enable and how that can be utilized for building a decentralized blockchain, a decentralized network, where actually it reduces costs for individuals, reduces costs for large enterprises. To hold personal data information or client information of other corporates on your database is expensive. It's expensive. You have to have compliance teams around that, monitoring that information. It's expensive in terms of the legal costs. It's expensive in terms of any data breaches, the insurance around it, the regulatory fines. If you can get to a world where that data is not centralized, where it is dispersed and back in the ownership and hands of the individual, and then that can be shared in a way that there is mathematical proof that that information being provided is accurate, is reliable, is robust, then you get to a world which is a little bit more fairer and allows and removes some of the risks that corporates currently have today. So we see a future where regulators begin to understand what it means. If I say to you, you should have data confidentiality around everything you do on the web, you probably will say to me, yes, I agree. So why is privacy, when you use that word, seen so negatively? It's time we reclaimed our right to privacy, to data confidentiality on Web3. It's right that we empowered ourselves, users, builders, corporates, to come and use a blockchain where their data is private, where transactions are private. And when I put it to you that way, probably nobody will disagree. So it's a case of regulators understanding and recognizing that. Just this week, Charles has been at the Google ZK and AI Summit. Google have a wallet which uses zero-knowledge technology. They don't advertise it as such, but they do use zero-knowledge technology. So what you'll see with the advent and introduction of new regulation and improved regulation that helps define the roadmap is large businesses will come and adopt this technology. And the important thing for us at Midnight, and also the Web3 industry as a whole, is that we are at the forefront and pioneers of that technology and not left behind. Because often regulation makes the hurdle for new entrants, new pioneers, that much higher, that much harder. And what we're going to do is make sure that these pioneers who've been evolving this industry aren't left behind because regulation is moving faster than they can keep up with. They should think about how they use that to bring that technology to a mainstream audience.
I think it's you're fitting into a problem that has started to pop up through the privacy issues that we've seen with social media platforms, where you basically just approve whatever terms there are, not reading through it. Nobody reads the 30-pager.
Yes.
And then the big lawsuits took place against Zuckerberg and the other platforms, where they were taking and extracting the data with your approval, but not really with your approval. And then a lot of people started to realize, hey, a lot of people are using my data and setting it through. What are some actual use cases that you see right now that are likely to adopt programmable or rational privacy in the short term?
Yeah, look, Michael, that's a great point you make around data and how it's monetized by companies. If you think about the web today, you have to opt out. You have to demand that your data is private. Think about cookies. Normally by default, the first button you see is accept all. And the reject all button is normally hidden somewhere further down. Why is it that way around rather than making privacy by default? So there are new browsers like Brave, who we're partnering with, who do put privacy first, that the individual gets to choose. So at Midnight, we have the same ethos. It's privacy by default and then disclosure by choice. And choice gives you freedom. Choice empowers the individual or the builder who's designing and building on Midnight. So we have many partners today who are building on the Midnight testnet. I can give you many identity and financial space. So you could get to a place of a private stablecoin, which can be gated for, US part individuals or non-US or regulated DeFi pools and things like that. But I'm going to focus on a medical use case because again, medical data is very sensitive. You don't want to disclose if you're ill. You don't want that information being publicly available. You don't want to expose what medication you're using. So we have a partner with a healthcare clinic based in Turkey with over 3 million patients and also the associated data to that. And they've been working to expose proof of their clients and their clinic, their patients on midnight, such that that information can be shared without disclosing sensitive information. But more importantly, in the future, that information can be opened up to research from large pharmaceutical companies. And they can do so in a way that that information, again, is not exposed. So the details of a particular patient is not exposed. But equally, the query from a large pharmaceutical company is not seen by other pharmaceutical companies. If I'm querying a subset of data, I don't want my competitors to see what I'm looking for because they might come and look in the same space and create a drug that is, in competition with me. So what that allows, if you think about the evolution of that, what it allows is that clinic to now achieve additional revenue by exposing proof of that data to those pharmaceutical companies. Not only that, but as they get that additional revenue, one of the benefits of that could be that they give lower premiums, lower insurance, lower costs to their patients. Now, if they get lower costs for their patients relative to their competitors, then they may see more patients, which will drive revenue, which increases data, which will allow more revenue to come in from pharmaceutical research. So you create this really nice, almost virtuous circle. And most businesses try to make profits by either increasing revenue, increasing the price, or by reducing costs. And here with this technology, there's a potential to both increase revenue, but also to reduce costs for their clients, which then brings in more revenue. So that's a really interesting use case that we're seeing. And again, we're working with a partner in Turkey because, again, regulations are slightly easier there. So the barrier to having those kind of builds, that conversation is lower than in other markets where the regulations are a lot higher. But supply chain, stable coins and RWAs, you should be able to hold assets in a way that it's private, that the issuance is public, but how you hold it, how you present it is private. You should be able to be paid in stable coins in the future, but you should be able to do so in a way that nobody sees. Your colleagues, your partners, others don't see what you're getting paid because that's very confidential information.
Yeah, well, in the Web 2 world, it's actually still private. But once you go full Web 3, then it's indeed, again, fully transparent.
Exactly.
That was a great example. Another very relevant topic right now is stablecoins,
Yes.
which is primarily on the ETH blockchain,
Yeah.
which then is fully open and out and transparent out
Yes.
there. How do you see that evolve, and how can rational privacy be important when it comes to stablecoins?
Yes. Look, I think we've seen the evolution of stablecoins. It is the theme of the current theme, stablecoins and RWAs. So we know we have the NFT phase, we have the meme coin phase. Now it's very much about stablecoins. Almost there are many blockchains, there are many, many stablecoins out there. Everybody want to produce a stablecoin. But what's happening in the US with the Genius Act is bring that into the mainstream. So now you're seeing the large actors, the banks, the financial institutions, where blockchain was meant to come and disrupt them, coming into this space. Because as part of the Genius Act, what it requires is KYC, KYB of the stablecoin holder. And in blockchain today, that doesn't really happen. Any wallet almost in any chain can hold a stablecoin. There is maybe some screening of sanctioned addresses to ensure some limited form of KYC. But the reality is you don't know who the owner of the stablecoin is in almost every example. So one of the requirements of the Genius Act is that there is some KYC, KYB around that the stablecoin is backed by suitable assets, suitable treasuries. But the problem with that is it's transparency. It still remains transparency. Today, let's say, Michael, you work in a small company, 4 or 5 people, and you decide to pay all your employees as head of that company. If you do that using a stable coin, then let's say you paid me. The first thing I do is go, oh, okay, I got my money. I might check which wallet it came from, which would be your central wallet. I might then check, do you have enough assets in that wallet to pay me next month and the month after? So it gives me confidence that you as an employer are stable and reliable. But what I might do is also look at all the other transactions going out. And in doing so, I can see how all my other colleagues are being paid. And then that will create disharmony, because the first thing I'll see is maybe I'm not the highest paid employee in your company. Maybe I'm not even close to that. Maybe I'm the least paid, lowest paid. So that creates friction in a business. So if you want true adoption of stablecoins, you need privacy and identity. The identity layer, the proof layer, creates gating. It says, I am an accredited individual. I'm of the right age, right jurisdiction, right corporate entity, whatever it may be, to own this stablecoin. And when I do, I hold it privately. So every transaction is just a proof. And it's a private transaction that happens between myself and you. Nobody else needs to see that. Nobody else needs to understand that, except maybe a regulator. Maybe you have to pay the taxes for your employees. So you can show proof that that happened to the tax authorities, but nobody else. And that's, people confuse disclosure as a breach of privacy. It's not. Compliance is not a breach of privacy. Disclosures are selective. And again, it's between 2 consenting parties and enabled because I, the employee, say, yes, I approve that. So people often think compliance and disclosures are the opposite of privacy. But what you'll have is a convergence of fully private, permissioned, and fully kind of unregulated, no permissioning, no identity, no KYC. There'll be a convergence, and that technology and that convergence will see mainstream adoption. We'll see regulators understand it and build the proper rules and regulations around that. So in Midnight, we have stablecoin providers who are building private stablecoins. Stablecoins where, again, you can see the details of the stablecoin publicly, but the ownership is private. The transactions are private. And if you extend that, you can end up with the same stablecoin, but in different pools. You can issue a US dollar stablecoin, which is only for US persons. So as you come into the transaction, you provide proof that you're a US person and nothing more than that. You'll be enabled and allowed to own that version of the stablecoin. And if you and I, Michael, we're outside of the US, so we prove that we're not US, then we'd go into this same stablecoin but the other pool. No different to how currencies work today. You have dollars, you have euros, you have sterling. And access to that is governed by proof of where you live and what your business is. So we see an evolution in terms of moving to that space. But the key is that within blockchain, you can still be disintermediated. You still empower the individual with that freedom of association, commerce, and expression.
Thank you for that explanation. I wanted to discuss another topic, which is the token.
Yes.
The Midnight white paper introduces 2 tokens.
Yes.
And to be correct, it's Night and Dust.
Correct, yes. We think of it as a token and a resource. So we think of it as a dual tokenomic model. We think of it as a cooperative tokenomic model. And I'm glad you've asked this question because I've had a number of questions around this. So I'm going to break it down and explain why we've done this.
That tackles a lot of questions.
Yeah. So let me have a stab at this. In the world today, you may own an iPhone. And if you own an iPhone, you use euros to pay for that iPhone. You don't use Apple shares. When you buy your groceries at a large supermarket, let's say Walmart, you pay for that in dollars, not in Walmart shares. The shares, the equity, is an investment. It's volatile, and it's an asset you want to see it go up in price and value. The actual commodity, the utility, the use case, you don't want that to be volatile. You want that to be steady. Yet in blockchain, with Bitcoin, Ethereum, and every chain that's followed, the very asset that gives you ownership and governance, the token, is the very token that you cannibalize to pay for your transactions. So your asset value or your asset size is always decreasing every time you transact, because you take a little piece of it away to pay for the transaction. And equally, as the asset value goes up, the cost of your transactions goes up. So when we talk about widespread adoption, if you're a large corporate, how do you predict capacity in a network like that? How do you predict cost? It becomes very hard to do that. So in Midnight, we have separated the utility and ownership, the Night token, from the resource, Dust, which gives you computational power in the network. So Night is ownership governance. It's unshielded. It's a public token. Initially, we launch as a Cardano native asset. It will be volatile and will move and behave like any other crypto asset. But if you own Night, it will emit perpetually Dust. And Dust, as I said, is that compute function on Midnight. And when you use Dust gives you a shielded computational power. It's like getting cloud credits on AWS or Google Cloud or Microsoft Azure. And yet, because you own Night, you get Dust emitting perpetually forever. And therefore, if you know how many transactions you're going to execute, you can calculate very easily how much dust you require. And because you know how much dust you require and how much dust is emitted from Night, you can then calculate how much Night you need to own. So it's like plugging into the grid. Night is your electricity substation. Dust is your electricity. And as long as you continue to own Night, you continue to receive Dust, the electricity, which powers your transactions. But Dust is decaying. And the reason it decays is we do not want Dust to have a store of value, because then it becomes a privacy token. And by having it decay, it only has one function. That's not a transfer of value. That's an execution function, an execution value. So we then enable the builders to start transactions or users to start transactions shielded. So their data and their metadata, more importantly, is protected. And then through the applications, through the smart contract language, Compact, they can provide disclosures as and when appropriate. And that's really important in design that we've taken very purposefully, because that allows now cost predictability and capacity predictability for builders and for users. But the other thing that encourages is cooperation. Because today, if you want to go and work from Solana with Cardano or Solana and Ethereum, you need to own the other asset. Solana holders have to own ETH or ADA. So in order to transact on the other chain, that means they're taking an investment decision on the other chain. What Midnight allows with its dual tokenomics, its cooperative tokenomics of Night and Dust, is if you now want to come and build a hybrid application from Solana, from Cardano, from Ethereum or Midnight, you don't need to own Night. You don't need to take the volatility of Night. You can now find an owner of Dust who can lease you capacity. So you're only paying for transactions as a service. You're only paying for the computational power as and when you need it, which is what happens in almost every other technology in Web 2. So what we're doing is we're evolving tokenomics. We're saying there's a different way to do this. And that enables fully shielded, compliant transactions going forward in Midnight.
Yeah, one of the questions that I wanted to ask regarding the token is, which is typical, where is the demand coming from for a utility coin? And for Night in this case is probably more difficult than for Dust, because Dust creates the demand for Night, I would say, or?
Well, Dust is what you need to execute your function. So as I said, Dust is your electricity. So the demand for Night is, if you're a builder, how do you guarantee capacity? Well, you guarantee capacity by having Night. Without Night, you cannot access the network because Night emits dust. So what you'll have is demand for night if you're a builder, because you're guaranteed the capacity you need. If you don't have night, then you have to go and find somebody with dust who's willing to lease that to you. And therefore, as you transact, there might be events or scenarios where dust is constrained, and therefore you cannot lease it to execute. So the only way to guarantee capacity and access is to have night. And that's where the demand comes from. Equally, by holding night, if you're a large builder, user of the Midnight Network, it gives you access. But if you're a night holder and you care not one jot about transactions, you just care about the value of night and what it does, you'll be emitting dust and not using it. There's an economic model there where you could lease dust and earn a revenue for holding your dust. It's like having a solar panel on your house. You can use the electricity to power the appliances in your house. But if there's a lot of sunshine, which doesn't happen very much in the UK where I live, but if there was a lot of sunshine, you might create more electricity than you use. And in that case, you sell the electricity back to the power grid. Dust is equivalent to that. If you have more dust than you require, you might find an opportunity to lease that to other builders, other users, and create an economic model around that. And we've seen interest around that, not only from large builders, large potential claimants of night, but also custodians. Custodians will be large holders of night because their clients may want to come and custody night with them. Therefore, they'll have an economic model where they could potentially lease dust. And therefore, you get to a place where a large corporate, which does not want to own a volatile crypto asset, they just want to transact on the blockchain, can now acquire transaction as a service through a custodian or through a platform in that way.
How are you going to launch the token? As in, there's no VC, so there's like not really any sort of cliff or vesting for them.
No.
To be relevant.
So we are going to give away 100% of token supply. So the Midnight Network will have issue 24 billion night tokens in total. And we are so confident around the technology, and we believe that this technology should put the community first, builders first, that we are giving away 100% of supply. In fact, that started last week, the GlacierDrop, which is an innovative, radical, but fair way of distributing tokens. And in this first phase, which will last for 60 days, we're enabling eligible addresses from 8 different ecosystems. So this is not just Cardano, this is more than Cardano. We're going to distribute to 8 different ecosystems to eligible addresses for them to come and claim their night. That's the Cardano, Bitcoin, Ethereum, Solana, Avalanche, BNB Chain, XRP, and BATS, the Brave browser network. And we're saying to them, look, we've created this new technology, this privacy enabling, programmable privacy at your fingertips. Come and partake in this technology. Come and help us launch the network. By owning Night, what we're giving you is capacity to the network, access to this network. Because your Night will create and emit dust for you to come and exercise transactions on the network. So in fact, as I said, we've not taken any VC money, fully backed by Charles. We're actually giving back to the VCs. They will be recipients of this because I'm sure they are holders of all of those coins and tokens. And what we're saying to them is, look at your portfolio companies, look at your builders. How many of them could benefit from our privacy enabling technology? And therefore give them the capacity that we've given you for them to come and build. It also creates a new VC model going forward where people building in this ecosystem, normally when you invest in a company, that money goes to not only building the tech, paying for employees, but also buying the token. Here, VCs who are getting Night can give the dust to their builders to encourage their builders to build. So they don't have to take volatility in the network. They just get capacity and access. So we're very pleased to be changing the way things are, not only the way we're doing privacy enabling technology and rational privacy, not only how we're looking at tokenomics, but also how we're putting community first, a fair distribution mechanism to these 8 ecosystems. And as I mentioned earlier in the podcast, we launched it last week. And already within a week, we've been overwhelmed by the support and what the community is doing. Across all 8 ecosystems, we've seen demand. We've had almost close to 60,000 claims so far in a week. Over 1 billion tokens have been claimed, over 4%, close to almost 5% now. And that trend is just continuing. We've announced large partnerships with blockchain.com, with BitGo, with Fireblocks, large wallets, large institutional custodians. And there are more partnerships that we'll announce over the course of the GlacierDrop. Because again, what we've been doing over the last 18 months, certainly as I've been here, is showing why this privacy enabling technology is the future, is where blockchain technology goes, and is where we achieve widespread adoption.
That brings me to the question going forward, which is we are getting hopefully in a phase where crypto adoption goes onto an S-curve, where the prices are going to go up, speculation goes up too. But if we look ahead for Midnight Foundation, and you are the president in that case, what is the most exciting part for you going into 2026 or in the second half of 2025?
Yeah, look, we have a huge responsibility to the foundation. Like any other foundation in this space, our role is to one, be the steward and guardian of the network, in terms of encouraging open governance and evolving that pathway. But also, more importantly, evolving the community. Community is key. Builders are key. Developers are key. And amongst that are partners. So both Web3 builders and Web2 builders. Showing them how our technology is new. It's evolving. It is an evolution of everything that's gone before. Everything that's gone before has led us down this path, down this journey. Without the pioneers like Charles, like Gavin, and Vitalik, and others, we wouldn't be here. And what we're always saying is that they've succeeded, but there's another step that we need to take. And that step is moving beyond just crypto token trading and actually embedding our technology as a technology stack within large corporates, within Web3 builders. So just today, as you mentioned, you might use Microsoft as your programming language on your laptop and still use Google Cloud or still use AWS. You can make a choice. We're saying with Midnight, the cooperative tokenomics we've introduced with Night and Dust, with the privacy enabling features, that we can actually take a leap forward in terms of adoption. So what I'm excited by is seeing many of our partners and builders bring their applications and their use cases on chain. So others can see what we are enabling, and it encourages more demand, more people to come into this space. There are a number of initiatives that we're working on that we'll announce throughout this year into early next year, which excites me. For me, what we've done with Charles' sort of funding and backing is build, technology which we think is evolving and it takes us all forward. But also, we've done it in a very commercial way, in a very community-led way. And when I say commercial, thinking about what gets adoption, what drives demand. Because with that demand, you have dead chains. You don't see much going on. How do we create demand both natively, but also end up building hybrid applications between Solana and Midnight, between Ethereum and Midnight, between BNB chain and Midnight, Cardano and Midnight. But then at the same time, with that commercial sort of lens, how do we focus on the community? How do we ensure that the small builder, the small enterprises, the technology that this was meant to help them encourage and open up, those innovators, those pioneers, are encouraged to come to Midnight, are supported within Midnight. And one of the most important things we could do at the foundation is to listen. I have an amazing team within the growth team. I have an amazing BD team, DevRel team. We will build out our community engagement program. Our governance programs will come out. And the key is for us to get the message out, get Night into the hands of people and builders, give them access to this network, and just empower them. Just give them that vision of autonomy, of disintermediation, of a true blockchain that, was the vision of Bitcoin was, and Ethereum and others have tried to do, saying, look, we're evolving. And for me, that is exciting. Building from grassroots is exciting. It's challenging. It's scary. It's long hours. As I say, I'm ably supported by a great team at the foundation, a great team of Shielded, but also Charles and his team. But for us, it's a very exciting time, and we look forward to that future.
Well, I've been in the space for 8 years, building multiple enterprises. It's as exciting and exhausting at the same time.
Yes.
Especially when you're kind of depending on market exposure and the volatility. It's even another level. What's something you believed in 5 years ago in crypto that you've completely changed your mind about?
Oh, that's a good question. So
I know.
So if we think about 5 years ago, the NFT fad that came along, everybody was very excited by that. And we saw a huge sort of boom in that industry, and it still exists today. Look, the NFTs haven't gone away, but the valuations have declined. Many people who've held NFTs have paid. You've heard or seen reports of them losing significant sums of money in that. So I think the evolution of NFTs, I still believe in them, but they need to evolve. You need to get to a place where NFTs can be private and they can be shared privately with each other. Just like artwork. When you buy artwork today in the real world, when you hear a Picasso is sold at an auction, you often hear it's sold to a private buyer. You never hear the name of the buyer. And that creates, some scarcity, some exclusivity around that item and the value of that item. So I think NFTs have to evolve. Privacy is one of those. NFTs that change as well. I've seen transformative NFTs coming into the marketplace. So I still believe in those, but maybe in a different form to the form that came out 4 or 5 years ago.
I think that's a good one. I think it's more going to be NFCs instead of NFTs.
Yes.
Like non-fungible contracts. One thing that I still am not sure about is the metaverse that kind of came into the tail end of that cycle.
Yeah.
Feels a little bit far-fetched, to be fair.
Yeah, look, I see, again, it tends to be regional. Like in the Asian markets, the metaverse is still very much a thing, very much a focus. Mm-hmm. But yeah, look, I agree with you. I can see why that hasn't quite taken off in the way people expected.
If we look 10 years ahead from now, and you need to look outside of the Web3 ecosystem and outside of privacy, what would be the bet that you would take and why?
I would bet on RWAs. This is where blockchain crypto technology meets a $1 trillion asset base, a liquidity base. We think about how the world works today, and there are certain inefficiencies. Look, I know this because I spent 20 plus years in that industry, in the financial markets, cross-border transactions, how collateral moves, how transactions happen, how settlement risk, credit risk, and all these things are managed. I think the advent of RWA is going to really take that industry forward, and both the financial industry and the crypto industry. I think you're going to see regulatory tailwinds that are pushing adoption of RWAs, marketplaces of that type. I think you'll see infrastructure around that, which comes from large adoption from the likes of the big banks, the big asset managers, that will bring in big liquidity, big volumes. And those volumes, that infrastructure will always beat any retail speculation, particularly during bear markets. So that would lead to less volatility in the space, and which will protect ultimately the retail investor long term. Also, the technology edge that blockchain provides for RWAs and for issuances, that kind of interoperability between public and permission chains, and where we see Midnight could be a very effective meta chain, a meta layer, is evolving. And then we've seen large participants like Stripe and PayPal announcing that they're going to use blockchain rails for settlements, for connecting merchants, for easier, quicker, faster settlements. So all of these things I think we'll see a huge advancements and investments into the space. And therefore, I think the RWA era, the stablecoin era, is here to stay, but that will usher in the big financial powerhouses. And therefore, there are blockchain technologies which exist today or which will be invented and evolve today that will really harness that technology and that industry. So yeah, RWAs is where I see the industry taking leaps and bounds forward.
That's fair enough. You've been building a protocol right now. You've been at the forefront and you've been working at startups basically your entire career.
Yeah.
What would be one piece of advice you would give to someone that's going to look at potentially building in Web3?
Don't do it. No, just kidding. No. Be thoughtful. Like, again, what is the problem you're trying to solve? What does your technology do? What is the problem it solves for? With anything, businesses need to be balanced. You need great engineers who have the ideas, who have the gifts, the skills to really build something innovative and robust. But alongside those engineers, you need strong business people. One of the things I said about the hedge fund world, and I draw many analogies between the hedge fund world and the blockchain industry, is in the hedge fund world, the hedge funds that succeed are ones that have great portfolio managers, investors, but also who very early on brought in a very strong business unit, a COO, a CFO, who could build the business and support the business around that. In the blockchain world, very often we're very focused on the technology and what the technology can do. That often we overlook the business side. How do you set up a business in blockchain so you can build the right team, support their HR needs, but also go and take your product to market, to the right partners, to the right builders, to the right communities? So I would always say, when you're looking at this and looking at a startup opportunity, think about what you're trying to build, think about your edge case, think about the problem you're trying to solve, but also think about the business you want to build around that allows you to support and deliver that vision.
And if Midnight didn't exist and crypto didn't exist, what would you do? Would you go back into the hedge fund world?
Yeah, look, if the crypto industry didn't exist, the blockchain didn't exist, if I hadn't been encouraged, then I suspect either I'd be working at another hedge fund, or somebody from the AI world would have tapped me on the shoulder and said, hey, come work with us. Ultimately, I've always been led by the desire to learn. I don't want to be the smartest person in the room. By a long way, I'm not. And I do not want to be. So I always want to be in an industry, in a technology that is evolving, that is challenging, that makes me want to come in each day and try harder, where I'm surrounded by peers who are forward thinking. I joined the hedge fund world in 2002 as a relatively young man because I thought it was innovative and it would be challenging and I would learn lots. And the exposure I got there and what I did was phenomenal. It gave me the platform to do what I do today. And blockchain has also given that same scope of coming into an industry where I'm surrounded by very bright intellectual people with a vision. And I'm honored that I'm here to help lend to that vision and to lead in taking that forward. So if I wasn't in this space, I'd probably be in something else that's equally innovative, equally challenging, where I'm surrounded by smart, visionary people.
Well, thank you very much for today's conversation and to clarify and discuss everything surrounding one of the most relevant topics, which is privacy and the position that Midnight takes in Web3, in Web2, and providing those barriers for people to be, well, I would say safe in the ever-changing world and everything that has been happening. I think it's going to be a great period for you. It's going to be a challenging period, an exciting period with all the partnerships and launches and things that are going to come up. In terms of the updates and all the announcements, where can people go to if they want to stay tuned?
Yes, thank you, Michael. So the GlacierDrop, as I said, launched last week. The only place to go officially for that is midnight.gd. So there you can make your claim. As part of the claim, we're not asking anybody to pay any fees, to lock up any tokens, or to disclose any sensitive or private information. Beyond midnight.gd, we will make announcements of both the Midnight Foundation webpage and the Midnight Network webpage around partners, self-custody wallets, institutional wallets, institutional custodians who are supporting the GlacierDrop for their clients. So keep tuned and posted there. And then as we evolve through the first phase of the GlacierDrop, we'll head into the scavenger mine period where the claim window opens up to everybody, not just the A ecosystem. So everybody will still have a chance to come and claim their Night tokens and to participate and gain access to the Midnight Network. And we encourage people to keep eyes and ears posted to those web pages, but also to our official social media platforms, both X, LinkedIn, and other platforms.
Well, once again, thank you very much for joining the podcast, and good luck with your journey with Midnight.
Thank you, Michael, for having me. It's been a pleasure. Thank you.